Everybody. So as Marty said, we have a pretty interesting panel today discussing, DeFi, which stands for decentralized finance. It's kind of companion term to embedded finance. There's a whole bunch of jargon that's being thrown around. Wanted to kind of introduce our panel. I've spent about 10 years in fintech, so kind of from the early days. I spent about 7 years at Cross-River Bank, which has been the bank to back probably 20 to 30 different fintechs and kind of change the business model as we know it, what a bank does. I'm currently starting a new version of a bank. So that's kind of my background. Would like to introduce you to three people who will be speaking about DeFi today. Tom George, Stewart Stockdale, and Sindhu Joseph. Everybody kind of has a slightly different background and kind of approach to this. So wanted to kind of kick it off and maybe have everybody do a little bit of a background. So Tom George is the president and managing partner of Constellation Real Estate Group. So we'd like to kind of hear back from him on things that he's working on, mostly in real estate. Stewart Stockdale was a formerly president and CEO of J.G. Wentworth, which everybody knows. And now he is working on a new venture, which is called Rellevate, which is a digital payments and banking platform. And then we have Sindhu Joseph, who is a CEO and president of a very interesting company that is running AI called CogniCor. I think she has a number of patents to her name. So with that kind of, I'll turn it to kind of go through everybody and ask a variety of questions. So we'll start with Tom and kind of go around the room, virtual room. Tom, do you want to give a little bit more background, kind of what you're up to at Constellation?
Yeah, sure. I'd be happy to. So again, my name is Tom George, and I'm the president and managing partner of Constellation Real Estate Group. Constellation Real Estate Group is a subsidiary of Constellation Software, which is traded on the Toronto Stock Exchange and spends its time acquiring portfolios of vertical market software companies to hold for the long term across over 100 industries. My focus is in residential real estate, and we provide software, technology, and marketing services to real estate brokers and franchises, multiple listing services. We also provide loan origination software to many mid-market banks. And there is some overlap there because your real estate broker also oftentimes wants to be your lender. And this technology area, over the last 16 years that I've been involved in it, while around the biggest transaction of your life, over time has become more and more focused on that transaction and on the fintech aspects of it. So we provide products such as eSign, loan origination software, which manufactures the loan servicing software, and we also automate many aspects of the transaction. What's been exciting in the last 18 months to 2 years is the acceleration of usage of all of our technologies by the pandemic. You're sticking home buyers and sellers, real estate agents, loan officers, your title agents, your appraisers. Everybody was told to go to their rooms and try to do all these things they do around this big, unique asset from home. And so it's been very interesting to see how that's pushed things forward in a way that I haven't seen in the past 16 years.
It's quite interesting. How do you kind of see as embedded finance, kind of you guys would be a perfect kind of embedded solution to a variety of applications to make the whole process of buying, homes much easier. So go from broker to lenders to closing. How have you kind of moved on to try to bring it together?
Well, you have an incredibly fragmented market across regions there are differences in local laws. Really national laws don't apply to the home buying process. And so we're having to address and automate different aspects of the home buying process based on the customer we're working with and based on the region that we're in. So, for instance, we provide EC to all realtors in the Florida Association of Realtors. And so from the perspective of getting to a signed customer contract and, moving the transaction forward, even signing, showing forms, which with COVID, require signature now, that piece of it there, we're automating. You look to some of our Midwestern banks that use our loan origination software. So now you move to the loan portion, and there's automation there. But it's definitely hard to do continuous from the point of looking for a home to servicing a loan. And what we're seeing is that our customers are combining our technology with technology from other vendors and things that they're building on a proprietary basis themselves to move the ball forward. But it's amazing how varied it is. And I know we all see the commercial, and it looks like you just pick up your cell phone, and next thing you know, you have a rocket mortgage. But that's really far from reality today.
It is a complicated process, which hopefully will lead to, future opportunities. Kind of as you look forward, where do you see these opportunities, and that fintech will be able to help to kind of streamline the process?
Well, there's an enormous amount of paperwork and multiple parties involved, and to the extent that all those parties can participate in a single platform, which is probably unrealistic, but fewer and fewer platforms, and submit the various steps to the various authorities in a streamlined way. That's really where the biggest opportunity is. We are seeing the beginnings of usage of things like crypto for validating home valuations, ownership of the business with something like an NFT, collateralization. So these new technologies are coming into the process, but it's interesting because you're not solving one use case. You may get it right in one state with one set of actors, but it really feels like there's so many variants. So it's a long road with the real estate transaction.
Yeah, no, that's quite interesting. Kind of pivoting slightly, Stewart, you have started kind of an, I guess would be a payment platform that maybe will be able to kind of also speak to the trends that are happening in fintech. And do you want to kind of give a little bit of background on your company?
Yep. Thank you, Stan, and thanks for having us. I've been in and around payments and in the corporate world for a while. I ran product and marketing at MasterCard. I was president of Western Union, and then, as you mentioned, JG. And it was clear to me when I started Rellevate that the 100 million Americans that live paycheck to paycheck, and that's a pretty accurate number. Most Americans can't afford unforeseen expenditures. That the banking products and the banking and the access and movement of money for middle and lower income Americans is very, very inefficient. And it was typical that the banks were built by the rich for the rich. And as you start going down that pole, the cost and the onerous fees are crazy. And so they've had to go outside of the banking system to get cash and cash flow. So that's why payday lenders and check cashers and all of these, onerous channels exist. So me and my team, which is a really, really good and experienced team, we built Rellevate, which is a digital banking platform. We really don't call it a challenger bank, but it's a quasi challenger bank. It's similar in setup, where you could move your money, access your money, and use your money. So we have, checking, we offer interest. We offer 38 basis points of interest. It's not a lot, but the big banks offer 1. And a little company like ours could offer 38 times what the big banks. It tells you something. We could send money, and we could send money ACH, which is a 2-day delivery, as well as real time. We're offering cross-border money transfer. So directly from us, you could send money to Mexico, India, wherever all the big remittance markets are. We offer 2 types of bill pay, the traditional ACH, but also we offer real time. So if the cable collector calls you and says, we're going to shut it off, if you don't pay now, you could pay real time. The US banking system has been built on a 2-day ACH. We're going to fast payments. We're kind of at the front of that. And then last but not least, we offer a product called Pay Any Day, which is earned wage access. So if you work today, we advance you half of your salary tonight, and it goes directly into your bank account, your Rellevate bank account. So the whole premise of the 2-week pay cycle is going away. And we're kind of disintermediating in that process to really get people access to their money, the day they work. And so right now we're working people like Dunkin' and school systems and Crocs and big accounts where they're having a hard time hiring people. We sell all of our products are primarily through employers, so kind of as a benefit. So we're embedding ourselves in a lot of big employers across the U.S. They include municipalities, they include fast food companies, they include schools and so forth. So that's what we're doing, and it's been an exciting process.
Okay, sounds quite interesting. You're really kind of looking to be in an embedded solution to a lot of these actual corporates or governments. Have you seen any response from your competitors, larger banks, to your moves, or have you been able to kind of stay under the radar?
I'd say we don't see the big banks playing within us. Obviously, we compete with them and people having bank accounts. So when we go out there to talk to employees, they may already have a big bank account that we're trying to displace. More, I see it as an additional account, and that's why we don't want to say that we're like a traditional bank. I mean, do you call Venmo a traditional bank? Most people don't even know what Venmo type is as far as a legal entity or PayPal or so forth. And sometimes they have a bank behind them and sometimes they don't. So we look at it as to be an additional account. There are some earned wage players that are playing out there that are primarily doing the earned wage piece. What we're trying to do is offer a whole host of products that really focus on addressing the needs of people that make 75 to 150,000, and in some cases make 25,000. And sometimes we're dealing with companies that pay people with checks, and sometimes we're asking people to switch accounts altogether.
Okay, and how have you been able to kind of put together all of these payment rails, banking background to basically set up yourself as an embedded solution?
Well, it took us about 2.5 years to build. If you look at the setup, you need to have a bank. You need to have all of these different capabilities. So the funds flow is incredibly complex. If you look at the compliance and regulatory, we have to deal with state law, federal law. We need to deal with employment law. We need to deal with payment challenges. So, the fact that we've been in and around payments for a long time really have allowed us to navigate all of this complexity. So make sure that we're staying, AML, moving money to across the world isn't easy. It's easy to move it. It's tough to comply. So we've been building for a while, but we've because we've been in the industry for a while, we've got access to great partners. So we work with Visa, we work with Technices, we work with some leading edge providers out there that we know, that we've known over years. So we could get it done. And 2 years sounds like a long time, but it's been a lot of building, primarily making sure that the regulatory process is well taken care of.
Okay.
Stan, can I jump in here for 1 second, Stan?
Sure. Go ahead.
Great. So you're offering all these services, but you didn't talk about what kind of fees that you have on these services. So can you discuss it at all?
Yep. We don't charge anything for the account. So people sign up for the account for free. ACH send money is free, and ACH bill pay is free. If you want to send it real time, we charge $2.95. If you want to pay your bill real time, it's $2.95. And we charge $2.95 for an advance on your earned wage access. So if you want to move over $200 of your earned wage access, we charge $2.95. It's not a loan. It's no interest. We have a minimum transfer of $20, similar to an ATM. There's actually no recourse because it's not a loan. So we purely in advance. We rely on that employee getting paid at that pay period and we taking our advance back. So fees are really low.
Deposit?
No.
Is there
No
a minimum
minimum
deposit?
No minimum deposit, and our fee structure is the same if you have $1 or if you have, $10,000 in there.
I guess my question for the panel is the future of fintech reduced cost, and then it's passed on to the consumers, or is the future offering more services that the banks that are the traditional banks or wirehouses just refuse to add on because they move at such a glacial pace? Right, there has never been an innovation from a bank, I think. Is that correct, guys? Outside of an ATM where they make a ton of money. I'm jaded. I worked for UBS and Chase for many years, so.
Well, it used to be that banks, I mean, if you go back in time, Citibank and all the, you talk to ATMs, you talk credit cards, there's a lot of innovation that happened in the 70s and the 80s that came from banks. And in my opinion, they seeded that business, right? They seeded the merchant acquiring. They, the other people came in and really grew the credit card business. But a lot of the innovation isn't happening in the banks. And you could argue that they want to buy their innovation over time. But in my opinion, the services that are being offered, not that yes, I think prices are going down. I don't think anybody should charge $30 for an overdraft. I mean, it just shouldn't happen. But prices are going down, but you could make money and we could make money at the prices that I just quoted, which are significantly less than what a big bank would charge. But you have to make it a little bit at a time. You can't gouge people. So I think the world is changing. And I think that, we're part of that process. And I think fintech is part of that process. And not every fintech will make it, but a lot of them will, and it's changing the paradigm.
Yeah, I think one of the issues with banks, frankly, is relative weakness of their technology stack, right? As we all know, there's three large companies that own the marketplace for banking technology, which is Fiserv, FIS, and Jack Henry. And if you're trying to do anything outside of those three, then you're basically working around. Those are the three large cores that control the majority of kind of banking technology in the US overall. Kind of with that, wanted to ask Sindhu, a little bit about AI that she's working on and kind of introduce, her company, CogniCor.
Thanks, Stanley, and great to be here. I think it's a nice segue. The last question from Marty, whether large banks and big companies, do they change, do they innovate, and so on. So we are, here to kind of, change those, age-old banking and financial services innovation, dearth of innovation. So CogniCor is an AI platform that revolutionizes scalable operational efficiency so that, that can accelerate the growth of large financial firms. So we, categorically sell into large financial firms. So to explain, what CogniCor is and, my background is in artificial intelligence. I have been working in the space of AI for over 20 years and also have invented 6 patents in machine learning and natural language processing. So CogniCor was launched with a strong faith in and fundamental belief that AI is can provide scalable automation to revolutionize growth. So to explain what CogniCor is, I think the best way is to look into the consumer space. So if you want to order a coffee machine today, you would go into Amazon. Within a couple of clicks, you are setting in motion an entire supply chain, and within 2 hours, you have that coffee machine in your doorstep. This is, the same cannot be said about, like, if you want to change the beneficiaries for your life insurance or withdraw from your 401k. So that, Amazon being, they really have to, move brick and mortar from, different parts of the world to get you that, within that 2 hours, get you that coffee machine. In the financial industry, you don't have to really move any hard assets. You just need to, make that transaction happen. And I believe, that can really be done. So we really want to revolutionize the financial industry in that sense, in making sure instant operations happen, both in the engagement with the customers and internal stakeholders, at the same time provide automation. So that is exactly what CogniCor provides.
Okay, and kind of discuss a little bit kind of the state of the U.S. banking technology and kind of the additions that you guys can make to it, given I don't know, the relatively dated technology that we're dealing with.
Yeah, so today, we primarily, focus on the wealth management, broker-dealer community, insurance carrier community, and so on. So that's where, we are seeing a huge, lag in terms of, technology and operations. Today, if you really want to, some of the examples that I have, given, if you want to onboard a customer, if you want to open an account, all of these things, like, you have to still work with a huge amount of forms, like, filling up forms and then submitting it and waiting for, somebody to look over that forms and things like that. So what we are, trying to change is all that from starting from that engagement aspect, like, how do you interact with a customer, to allowing the automation to take place using artificial intelligence. So discover the right form at the right time and fill up the form automatically by fetching data from backend systems, and then making sure that this is sent by DocuSign to different parties. All of those things are really, really hard for to make that happen today. Because of the disconnect between different enterprise systems, you have a huge amount of systems that are that doesn't work with with each other today. One of the primary reasons they don't work together is because most financial technology today is deployed on-prem. It is changing little by little, and COVID has accelerated pretty much some of those change to cloud. And I think that single transformation will enable a huge change in innovation, the pace of innovation. So as you are moving to cloud, and there is a lot of resistance in terms of data privacy protection and things like that. But if we can overcome all of those challenges and make sure every technology is operated on cloud and provide APIs to interoperate, then all of these changes can happen. So that, I think, that is one single fundamental change. Even with technologies like for example, in Bank of America, you have Erica as a digital assistant that seems to kind of provide a next generational experience. But if you look a little bit behind the scenes, no systems have changed. You would still see blue screens, where operators are operating. So that's where you need to, make changes, and that's where I hope AI can effect that change.
Yeah, no, that's obviously COVID has kind of impacted everybody. Stewart, Tom, kind of wanted to throw to you guys, how has kind of COVID changed your business and maybe accelerated it in some ways as well?
Go ahead, Tom. I'll follow you. You're on mute.
Unmute, Tom.
Okay, that sounds better.
Mm-hmm.
As I mentioned earlier, there was really a acceleration of the adoption of the technologies that we've been trying to have our customers adopt for years and years, due to the fact that your real estate agent who went out to the coffee shop and to youth sports events to gain new leads now is suddenly trapped in their house, and they have to work with online lead sources. Another big factor is what the CEO of Zillow calls the great reshuffling. And this is a permanent change to work location where folks that were trapped in Silicon Valley or here with me in Los Angeles can move to these smaller cities permanently. So that's driven huge demand in resort beach areas, vacation areas, places where people love to spend time, and they can now spend half their time or all their time there. So that's really driven demand. You know, how do you meet that demand, right? You do it through technology. There's a broader backdrop there in terms of, you know, there was a first round of venture money that came in to try to really disintermediate the transaction in the same way you've seen travel agents and taxi drivers disintermediated. It's really not that kind of transaction. It's a big transaction. You don't do it very frequently. It's very emotional. And so the second take on this venture investment is really around tech enabling and creating greater efficiency in the traditional processes. And so you have tech enabled real estate brokerages such as Side. You have pure play iBuyers like OfferPad. You have companies like Zillow creating, you know, iBuyer arms. And then you have the traditional players really in earnest making technology investments either through partners like us or through their own developments, you know, such as Keller Williams. But the problem the industry has always tried to address is a lack of ability to kind of capture all the aspects of the transaction and the economics, whether that's the real estate commission or, you know, originating the mortgage, title insurance, homeowners insurance, you know, moving costs. And so all of these companies are looking to really, you know, create or capture as much of that spend as they can, which should make things more convenient for the consumer. And, you know, consumers really appreciate that. Probably the most extreme version of that is iBuyer, where, you know what, you want to drop your car off at CarMax and drop your house off at OfferPad, you can do that today. And that's, you know, requiring a much more sophisticated financial strategy by those companies. But all these things have been, you know, really shoved forward like a big wave behind you from COVID.
And I'll just add, from our perspective, that COVID is probably accelerated us as well. It certainly made life easier for us in many ways. And we're a 100% virtual company. Our people are all around the country anyway. Investors never asked us, where are your people? Do you have a central office or not? And certainly, if you look from an employer perspective, you know, we sell to employers, right? So we sell, or municipalities or whoever it may be. So we go to the CEO, the mayor, we go to the CFO, and end up in HR. And you know, doing Zoom calls became you could get 4, 5, 6 sales calls a day instead of having to travel and lose 2 days as a result. And it just made life easier for us. The implementation probably a little more difficult because sometimes we like to onboard employees and do physical presentations. But a lot of people could now do Zoom and now do email and whatever it may be, text. So it certainly fast tracked a lot of the stuff that we were looking at, which would have been more expensive and taken a lot longer. So, you know, we're not complaining about it. Obviously, it wasn't good for anybody, but from our perspective, you know, and people are willing to go to a bank that they've never heard of before, right? So we're asking people to give us their direct deposit to somebody they never heard of before. They're going to get all these benefits. We do have the endorsement of the employer, so the employer becomes critical in that, you know, if your employee says that we're okay, odds are that they, you know, may try us. But I think COVID, in that sense, accelerated most things digital, or a lot of things digital.
Okay. And since we mentioned something that I want to kind of get everybody's take on and include into the, you know, there's been kind of expectation that Amazon has set up that you're supposed to kind of be done automatically, quickly, instantaneously. Do you see kind of a change in generations that maybe younger generations demand that? Yeah, or kind of older generations have kind of more patience to wait for things, or is that kind of an accurate assumption? Sir, do you want to take that?
Okay, do you hear this question? There's a question about cybersecurity and the natural need for it in fintech.
Well, from our perspective, it's, I mean, security is everything, and privacy. I mean, they kind of go, I mean, hand in hand. So, but cybersecurity is critical. We're dealing with transactions, we're dealing with money movement, we're dealing. Cyber is critical. Privacy is critical. We spend a lot of money on both of those facets, and we think that we have leading edge technology to make sure that not only we're compliant but ahead of compliance. So very important in the digital world, and the payments world in particular.
Okay.
It may be arguable that since you're virtual, you actually might be more secure than those non-virtual companies, right?
We think so. You were talking about systems and legacy systems, and I know the legacy systems from the three that you mentioned, and how far ahead we are from being able to integrate new products, change, add. But that includes security, and our PCI compliance processes are robust, and it's been pretty much easier to do than in some of those big legacy companies, because they touch a lot of arms, right? There's a lot of different arms and legs to those institutions on where data is flowing to. From our perspective, we have our cyber digital banking platform. It is 100% digital. Everything we do is API based. So we are riding the freshest, newest technology, and security falls within that. So yes, absolutely. And people ask me, I've been a couple of panels on, evolving a legacy bank to a digital bank. And I go, start from scratch, build a new one and build it in parallel, because trying to navigate through some of those systems to get to digital is probably more complex than starting from scratch, in my opinion.
That kind of leads to the next question of which is, is fintech a greenfield space, or is it really you're trying to, take away business from the existing, right? Because, I mean, if everybody remembers, McKinsey had their old projection of how many people would buy cell phones. It was like 800,000 people, right? And it was, and the main reason was because McKinsey said everybody had to go the traditional route of first putting in phone lines for people to get used to having phones. And they didn't realize people would just skip a generation. So I guess the question is, for you fintech guys, will people naturally just skip a generation and go right to you rather than walk into, a bank to cash their paycheck? And I'll give you a great example. I was in South America in Lima, Peru, and I was walking past a bank, and there was literally a line 2 blocks long of people. It was payday, people waiting to, cash their checks, because a lot of people don't have bank accounts, but they just take the cash when they can and walk away with it. So any thoughts on that?
Well, I'll start and then I'll pass it over. I think that the next generation, I have 6 kids and they're all in the banking world now. I don't think they'll ever go into a bank branch, to be honest with you. And I grew up in Mexico City, so I understand the Mexico and the rest of the world process as to who, the banked and the unbanked, and and even the U.S. Okay, 7 to 10% of Americans are unbanked, and about 20% are underbanked. About 7 to 10% of Americans are unbanked, and up to 20% are underbanked, which means that they have a bank account, but they really don't use it or trust it. And you'd be surprised on how many people still use cash. 80% of Western Union money transfer outside of the world is on cash. People physically showing up to a location and plop in $1,000, and it ends up in the other part of the world also in cash. But going back to, and I think the lines will blur on what is a bank account, right? Is Venmo a bank account? Is it holding money? Should it hold money? It should have a debit card. Does it have a debit card attached to it? The answer is yes to all of those, but are they really a bank? So how we interact with payments and how to react with banks those lines are gonna blur. And at the end of the day, consumers, especially that younger generation, are going to go straight to that. Long are the days that you're going to wait in line in a bank and hopefully the manager comes to see you within half an hour.
Yeah, we have a question, and Steve McCarthy's going to ask it. Steve has a loud voice, so I'll let him project.
Okay, I will try and be very thoughtful, Marty. This question actually I gave to Catherine Wood from ARC, the glamour girl. I asked this question down in Atlanta a year ago, and she couldn't answer it for me. I guess most of the people on this panel are talking about the benefits of disruptive technology. Would that be fair to say, gentlemen?
Disruptive technology, are you guys discussing that? Yes, right?
Pretty much that? Okay. Explain to me, who do you think is responsible for the disruptees?
So like disruptees is like people who lose their jobs out of...
Yeah, you think about this quite candidly. It's more of a social policy issue. We have gone from disrupting everything, and when you think about the fact that we have not invested, whether it's the venture capitalists, the universities, the endowments, the government, into the people that gets disrupted. So the 40, 50, 60-year-olds that have no place to go, whether it's in fintech, trucking, or whatever industry you disrupt, okay? You're not taking care of a whole population base that has tremendous impact on things like alcoholism, distress, opioids, et cetera, et cetera. So you've left behind a whole part of the world.
So
who do you think is responsible for helping with that?
You mean people who are losing their jobs?
Yeah, I mean, think about it. The whole industry. No, the whole industry is based on disruptive technology. And the question is, who do you think, from a societal point of view, should be kicking back to help the people get back to work, get back into careers, healthcare technology, whatever? Because everybody, every knucklehead in venture capital talks about the benefits of disruptive technology, but they don't explain the downside, and it's a lost cause, in my opinion. So I am editorializing, but explain to me how you guys deal with that process.
I just want to add just one comment. Okay, two comments. Number one, I ran offshoring at JP Morgan for 3 years.
Yep.
And not one person in the executive committee had a single thought about it. They were off. And so it was a great contradiction to Henry Ford, who created affordable transportation that his workers could afford. Yes. Meanwhile, JP Morgan a bank was laying off, many of their employees who were the best customers, right? So I think from the venture capital point of view, I guess what you have to explain is whether or not, if it's greenfields for people who aren't banked anyway, you're not really taking somebody's job away, right? So the question is, how big is the unbanked versus the banked, population?
You're disrupting a lot of the technology of people that were old-fashioned, green eye-shaped clerks are getting out of jobs. And you can say, well, that's not my problem, or maybe we should educate people. But who do you think should be funding some of this stuff? The societal government. Government. No, it's not the government. It's the endowment, the government. That's nonsense. It's not the government. It's the venture capital, the government, the endowment, and everybody.
Guys, we're kind of evolving into fisticuffs here. So, but
think about it from a societal point of view. After the government, he's running $6 trillion of deficit. 21 trillion.
Okay, great. Guys, any thoughts? And actually, Stewart and Tom, Tom, you have invasive technology in the real estate market. As a matter of fact, I just got a flyer in my mail the other day saying that the house two doors down just sold for XYZ, and the real estate commission was less than 3% because I think Rex or one of these, real estate decouplers was involved. So can you guys talk about that, like the disruptive aspect and how you're taking, money out of people's mouths that they use to feed their kids?
Well, as I talked about earlier, there was this whole wave of investment maybe 15, 20 years ago. And, the goal was you're going to be able to disintermediate the real estate transaction. And it didn't work. People wasted a lot of money because the nature of the transaction is it's big, complicated, infrequent, emotional. And so these real estate agents have continued to rule the roost, and these loan officers. And so really what's happening now is we're trying to wring some inefficiency out of the transaction. But this next wave of investment that we're seeing, I mentioned it, companies like Side and the evolution of what's happening with iBuyers is really the result of an incredibly resilient supply chain that could not be disintermediated. So I think there is a victory there in this respect.
And the FDIC just came out. I mean, the FDIC just came out with the report, and I think the profits of the FDIC insured banks was, $30 billion. So it's a question of maybe we're just taking a little bit of profit and kind of the fees that the banks could do without, and kind of redistributing it to back to the people who needed the most. Stewart, do you feel the same way, or kind of how do you think about it?
I look at it a little bit differently.
Actually, Stewart, I think you have a great argument for that, which is that you're providing banking services to unbanked and underbanked. I mean, I look at bankers like Ronald Reagan looked at the government. A banker comes to me and says, I'm here from the bank to help you. I'm like, right? So anyway, thoughts?
Well, not only that, but think of who our real competition is. Payday lenders. Should we be do I worry about putting a payday lender out of business who's charging 300-400% for a loan? Maybe those people shouldn't have a loan. I get that part too, but that's why if I could pay them every day instead of them going to take out a 300% loan, I think that's good for society. Yes, we may get some accounts from some of the big banks. I don't think the big banks are losing sleep about how many accounts I'm going to take from their lower income people, because they probably don't necessarily want those customers anyway. But at the end of the day, check cashers, we're looking to disintermediate, onerous channels. 30% of Americans can't afford an unforeseen expenditure of $400. And I know that was a quote being used by the political system, but that's true. And you may have other buckets to go get money when you may have a bank account, a savings account, a 401k, and a gazillion different buckets. A lot of people just count on their paycheck if they have a paycheck. So the fact that we could get that to them sooner, I'm not too worried about who I'm displacing. I'm really more worried about the 100 million Americans that we're going to help, to be quite honest.
Your argument is an argument of inclusion.
100%. Well, financial wellness, inclusion, and disintermediation. Now, there's a reason why those guys exist, right? Payday lenders exist because I guess there's a void. It's not that, so what we're trying to do is give an alternative to those channels, which is going to, to your point, Stan, you're going to give more money to the people that deserve it, which is the consumer. Now, when I've talked to some people say, well, isn't the real issue that Americans need to make more money? And I go, yeah, that's true. You can't really live on $27,000 a year if you have 2 kids. It's just a fact of life. I can't help them in that, but they shouldn't. I've got an instance where one of the companies that we onboarded, they go and all of their people were paid with check. And we have a little Bangladeshi guy that goes out and every 2 weeks, he cashes $1,000. They charge him 9% of the face value of the check. That they have technology to validate there's money in that account. It's not like they're taking that risk. And they charge him 5% to load every 500 onto a prepaid card. So that person's paying $100 every 2 weeks to cash their check. It makes $1,000. That shouldn't exist.
Sindhu, Sindhu, are you still there? Can we get some input from you? Because I know that wealth management products are, what's the word I'm looking for? Well, they're poorly structured, right? I mean, they're not efficient. Sindhu, are you there?
Yes.
Did I lose you?
Yeah. Can you hear me?
Yes.
Yes, I don't see you.
Okay, that's strange. I have my video on as well. I have a pretty different take on this question, and the question was on disruptive technology, and being an hardcore AI solution specialist. I can, one of the things that we are doing very interestingly within our company, and I think, this is one model where, other companies should also follow, is that, when we are, displacing one particular job that we displace is basically call center agents. customer service reps, and these are people like 50 to 60 years old, or even beginning their career 20 to 30 years old. And these two group of people, basically, we are taking those people and then helping them train our AI algorithms. So they are being the domain experts and training our algorithms and teaching AI systems how to basically respond to queries, how to automate, and things like that. So two things we are achieving there. One is we are putting them into new basically helping the being part of the new distribution and distribution chain. And second is they can move on to new jobs. Now they have become knowledge engineers, knowledge workers, and they contribute, they become part of the new economy. So I think these two things are really, really important, and we should take companies who are disrupting this should take an active responsibility in doing this kind of transformation as well.
Yeah, my last point is that if anybody goes to a bank branch these days, you see a lot of automation and kiosks and things like that. Same thing with McDonald's, anywhere you go. So I think that's kind of unavoidable technology. But people are still up and they're able to gather new skills. So guys, I have to get on to the next panel. We're just running really late. So, and Steve McCarthy has a habit of disrupting us. So we're going to silence him next time. Just kidding. Okay, great, guys.